Depreciation. What is depreciation? Depreciation refers to the reduction of the value of an asset. Why do we need depreciation? So we can actually accurately portray the value of an asset. The reason to do so is so we can actually have a better view of the actual financial performance and position of the business. What type of asset will be subject to depreciation? Typically, tangible non-current assets such as motor vehicles, plants, machines, buildings, etc. The reason of why tangible is because the non-intangible assets are usually subject to amortization, which will be discussed in another topic. And the current assets, well, their value are likely to be changing within the next 12 months. So therefore, we're not worry about the revaluation of those assets. What type of method can we use for calculating depreciation? Well, for tax purpose-wise, only two methods are available for calculating depreciation expense. The first one we look at is straight line depreciation method. So as you can see, how you would calculate depreciation expense under this method is to use the initial cost of the asset, so how much you have spent to acquire the asset, reduce that by the residual value, which refers to how much are you expecting to recover by the time when you dispose or sell the asset. The net amount of that divided by the useful life of the asset. Let's say if it was a laptop, we expect it to last for 3 years, then we divide it by 3 years. In the following examples, you can see the depreciation expense for this asset is actually being really uniform and constant over the life of the asset. Therefore, it's easy to calculate and create less hassles for the user. The second method that we're going to look at is diminishing value. Compared to straight line, as you can see in the calculation formula, this one is actually involved with much more complicated calculations in terms of the calculation of the expense. But there's an advantage to this is the fact that, as you can see in the second column, depreciation expense compared to the straight line method is actually being much more aggressive in terms of the reduction of the value in the early life of the assets. So this allows the taxpayer to be able to claim a bit more in the early useful life of the asset. So here's the case study. What could happen if we underestimated the depreciation expense, and what could happen when we overestimated depreciation expense? Well, in that case, we actually need to look at the double entry in terms of how we're going to record depreciation expense. First of all, we would debit depreciation expense. And obviously, since this is an expense account, this is likely, and in fact will, reduce your current year profit. And since double entry accounting, we would credit to accumulated depreciation expense for the asset. So, as you can see, if the expense is being underestimated, then in that case, your profit will be overstated and you are likely to be paying more tax because you have a higher profit. However, if the expense is overstated, then in that case, you will actually record a higher amount of accumulated depreciation of the asset, since in your balance sheet, your actual value of the asset is usually goes by asset, initial cost 10,000, and then less your accumulated depreciation, let's say it's 5,000 instead of the actual 4,000, because you have actually overestimated your assets depreciation amount for this year. So therefore, your actual value of the assets shown on your balance sheet is only 5,000 versus the actual amount should be 6,000. Therefore, in the balance sheet, the company would have a lower, or we shall say weaker financial position, because of the fact that the amount of the asset is being actually recorded as a lower amount compared to what it actually should be. Thank you.